And welcome to another edition of Taking Stock for the week ending the 4th of April 2025. I'm Trinh, Head of Research at Stock Doctor, and joining me today is our Senior Equities Analyst, Jason Yin, to stream to you all things share market. Welcome back, Jace. How are you feeling today?
Pretty good, Kien. Easter's just around the corner, and there's probably going to be plenty of chocolate eggs at home over the next couple of weeks.
Yeah, looking forward to that sugar hit, especially among our kids. That will really give them that energy boost. But before we get started, just a quick yet important reminder, the information we provide today is of a generic nature and shouldn't be taken as personal advice. Remember, shares are volatile, so any past performance figures shouldn't be relied upon as a guide for future performance. Well, Jace, what a volatile week it's been. Markets have been spooked. And those Liberation Day tariffs, they appear to be far more aggressive than anticipated. And that sparked a global sell-off across equity markets. And these new measures, now they come into effect April the 5th. They've been imposed with a minimum 10% levy on all countries except for Canada and Mexico, with many facing even higher rates based on VAT and trade imbalances. And Australia was not spared, with Trump citing trade imbalances, including beef exports for us.
Yeah, there's definitely a flurry of activity in the markets yesterday and presumably also today on Friday as well. I mean, the global growth outlook has definitely weakened, Kien, and traders are now pricing in aggressive rate cuts from the US Fed and also potentially with the RBA as well. So with the cash rates kept on hold this week with the RBA, we're now expecting the central bank potentially to cut rates in May and also up to three further cuts for the remainder of this year.
It's very interesting how markets reacting, Jace. While the direct impact of the new tariffs, specifically to Australia's economy, will be modest, given that only about 4% of Australia's goods are exported to the US. The broader concern here is the indirect impact from international supply chains. For example, our largest raw commodities export partner, China, we export to China things like iron ore, copper, also aluminium. They are typically refined and processed and turned into manufactured products like cars, appliances, and building materials. And that's to be re-exported to other countries like the US. So tariffs to China will obviously slow down the demand for these goods.
Yeah, and it's definitely interesting, especially when you say cars can, because there's multitude of parts that go into it from various countries around the world. And interestingly as well, Ken, Trump has hit Australia's largest trading partners with more tariffs, including China, like you stated earlier. We've got Japan and South Korea, and they're facing tariffs in respect of 34%, 24, and also 25% respectively.
Yeah, no doubt that's why the market is reacting the way it is, Jace. But I noticed that quite a few of our star stocks were sold off during the week as well on tariff announcements, specifically some stocks like Netwealth and Hub24. Now, it doesn't seem that intuitive that they, as wealth management platforms here, they don't really have US exposure, but yet they were sold off.
Well, it's interesting you asked that question, Ken. These stocks are what we consider high beta exposures because they are leveraged to share market movements. So, for example, when markets fall, this reduces their assets under management and potentially funds under management as well. And this could lead to a decline in investor sentiment when the impact of net outflows and potentially also influence its earnings outlook.
Right, so it's not the just the earnings impact here, it's more about the markets as well. But I noticed that also on that day, a major broker downgraded the stock, both Netwealth and Hub, cutting their price targets quite significantly as well. And this also added fuel to the fire. So, Jace, let's talk about some of the other stocks that have been directly impacted. They were sold down, and one of them was home appliances manufacturer, Breville Group. What's the concern here?
Well, Breville shareholders didn't really have a good day towards the end of this weekend. I mean, the share price fell quite substantially, and that's probably on the back of the company being quite rather vulnerable because 90% of its goods are made in China and 50% of its sales comes from the US. Now, the company has told us that they've built up a relatively large US inventory to shield short-term costs and also they plan to cut some of their manufacturing and move away and pivot away from China in the years ahead. But having said that, we'll wait to see what happens. But with a lot of these tariffs, potentially this could influence and introduce weaker US demand and also put a pressure on some of their margins.
Yeah, very interesting, Jason. And this is an active risk that we're closely monitoring as well. But we're talking about retailers. Another one that was sold down was also fast fashion retailer Lovisa. Now they produce those cheap jewelries and they sell them across to this younger demographic. Now, with the potential for further interest rate cuts, though, I would think that some of these retailers could be beneficiaries there as well.
Yeah, look, there are plenty of moving parts right now, Ken, and as more facts come to light, we'll probably have a better understanding, probably in the next day or probably in the next week or so. Remember that interest rate cuts here are a function of slower economic growth. But having said that, Lovisa sources a significant chunk of its products from China, and they also have a relatively healthy US rollout plan. So any US tariffs there could potentially pose a headwind on their growth ambitions. Now, the management team haven't really detailed any mitigation plans as yet. Potentially, they could lift prices or they could pivot some of their sourcing to places like India and Thailand. But a lot of these countries are also under tariff pressure as well. So this could negatively influence its US rollout plans and potentially impact the PE that it was trading on.
Yeah, definitely, Jace. And among other retailers as well, I noticed that vehicle accessories manufacturer ARB Corp, the business does have 10% of its revenue generated from the US as well. And the ARB also was sold down. So there's still plenty of uncertainty on the horizon. Tariffs, they may trigger more rate cuts or create cost challenges for exposed stocks. But at the end of the day, high quality companies will adapt just like they did during COVID when their supply chains were disrupted.
Yeah, that's right. I mean, we've also seen this trade war before, right, Kien, during Trump's first term in 2017 and 2018. And the result of that was a number of companies have rerouted a lot of their supply chain. So the key here is not to get too caught up in the noise. I mean, throughout history, these events have led to potentially great opportunities for investors, especially across what you mentioned, the high quality businesses that have been sold down rather heavily or unjustly. So the thing here for many investors is to look for some of the biggest laggards over the past few months. And these could include potentially Lovisa, you've got Netwealth, Pro Medicus, up 24, Zero, WiseTech, and also include Aristocrat Leisure in there as well.
For under the microscope this week, let's take a closer look at one of our most long-standing star stocks, a stock that's been sold down by over 30% from its highs, and that's medical imaging software business, Pro Medicus. The business has been winning contracts and earnings revisions under Golden Rule 3 have been quite strong. So, Jace, why has the share price dropped so much?
Well, Pro Medicus is definitely an interesting situation, Kien. I mean, I've
Mm.
had a lot of conversation with a number of members, and I sort of pointed them back to the first tariff when Trump was in power, and then that was around 2017, 2018. Pro Medicus share price also went through a period of volatility as well. But in terms of the recent share price movements, we think that it's probably driven by some investors de-risking because a lot of the investor confidence have fallen due to a lot of these uncertainties on tariff 2.0 and also any changes in US policy. And also, two, potentially because of Pro Medicus's runway of growth is very heavily dependent on the North American market. So, from our perspective, we don't think tariff really impacts services like Pro Medicus, but if there's any deterioration in the US economy or if there's any constraints in terms of funding for medical institutions over in that area, we think this could impact some of the short-term growth drivers.
Yeah, thanks, Jace. But let's put everything into perspective here as well. After the recent share price depreciation, though, and if you look at over the last year, the stock has still returned close to 100% return for investors. So it's not a surprise to see some of that profit taking among investors. The stock is trading at a large discount to fair value now under Golden Rule 5. but I noticed that the PE ratio, it's still quite elevated, trading in excess of well over 100 times. What should investors do here?
Yeah, the PE does definitely sound very, very rich, if I can use that word, Kien. I mean, we the reason it's rich because the company has a very long growth runway, and the market is expecting it to take a lot of share in the medical imaging space in the future. I mean, based on our estimates, we probably estimate that Pro Medicus global share is around potentially 5%, and that's probably expected to grow by around 1% every year over the next 5 years. The market is anticipating Pro Medicus to reach probably a market share of double digits in the next couple of years. So that's why it's being priced on such a high PE. I mean, on the whole, with growth stocks like Pro Medicus, it's not really useful to sometimes just look at PE multiples in isolation because of the accelerated growth that we're expecting from these companies. And this valuation multiple can come down quite rather quickly if we see a significant increase in the earnings ahead.
Yeah, that's right, Jason. Very interesting there. But I noticed that the stock has also triggered an exit on the SD30 TSR, the 30% stop loss indicator. So those who are sensitive to downside trends should remain on the sidelines for now. Let's go back to that topic of US tariffs, Jace. I mean, you mentioned that Pro Medicus has a large US exposure and investors have been selling it down because of that. But really, yeah, let's just dwell into those facts for a minute. Will the tariffs actually impact their earnings?
Yeah, as I said earlier, it probably won't be directly impacted, Kien,
Hmm.
because Pro Medicus may feel the impact of slower US growth if the healthcare austerity measures get tightened up. So, for example, they are proposing cuts to Medicare and also Medicaid as well, and combined with a bit of inflation, labor pressures, and also lower reimbursement rates, these could potentially influence and also constrain hospital budgets as well, thus leading to potentially delaying any large IT investments, and also favoring phased rollouts or subscription models. And this could effectively slow the pace of any Visage contract wins as well, and which is why contract wins and the pace of these wins is why the market has given it such a high PE multiple, because we really need to see those earnings grow or accelerate quite rapidly.
Yeah, very interesting. So despite its strong value proposition, especially under Golden Rule 5 here, Pro Medicus may face longer sales cycles and tougher negotiations in the near term. However, its competitive position, especially in that medical imaging software space, with its founder, Dr. Sam Hubert, still at the helm and running the show here, that should help drive its earnings growth over the longer term. So, with the trade tariffs in the spotlight this week, and this is an extension to a similar question we posed about a month ago, and is quite topical for a lot of investors, especially among our star stock universe. But one of the questions posed is which star stocks would be most at risk of tariff impacts, especially prevalent here, given that the US has implemented those tariffs with a bit more certainty now?
Yeah, it's a good question, Ken, and probably the first place to start off with is to consider some of the star stocks that we have and really try to assess the company's exposure to the US markets, any reliance on imports and exports, and also potentially look at some of the supply chain dependencies as well. I mean, this could all be a bit of a challenge given that the information around supply chains may not be really disclosed by some of these companies.
Yeah, that's right, Jace. But we noticed that numerous star growth stocks have exposure to the US, and we spoke about the risk to the retailers earlier this episode, including Breville and ArbCorp and Lovisa as well.
That's right, Ken, and we've also seen a bit of volatility in the healthcare sector as well, and especially if the US implements tariffs on Australian pharmaceuticals and also devices as well. I mean, for example, Fisher and Paykel's share price got sold down probably earlier this month or in the last couple of months because it had a large manufacturing facility over in Mexico, and Mexico tariffs were being debated. Others to include into this mix as well. You've got CSL, Cochlear, and also ResMed. They've also seen their share prices being a little bit volatile as well, due to various exposures within that region.
Yeah, and outside the healthcare sector, I notice technology stocks, say for instance WiseTech, Codan, and Zero, they do have large US exposures, but just remember they sell software and aren't directly impacted here at all. Similarly, you've also got other companies with large US exposures like Computershare, Brambles, and Aristocrat Leisure. Now, they would be impacted indirectly through, slowing economic growth here and sales in the US, but in terms of earnings impact, it's very limited.
That's right, Ken. And also another company that does look like it was going to be impacted was something like a Treasury Wines estate. The company management came out to say that the overall impact is rather minimal because the company has established US-based winemaking, and that was on the back of prior China tariffs, ironically, on Australian wine. So the overall impact this time around should be rather minimal.
And speaking about Chinese tariffs, Jace, I noticed that our commodity exporters such as BHP and Rio Tinto, they will also face headwinds from lower demand from China following the flow-on impact of the US's 35% tariffs on Chinese goods.
Yeah, it just seems like with the broad brush approach that Trump has sort of enacted on these tariffs, seems like no one's really winning. I mean, tariffs from an education point of view or from a book point of view, they're not really great for economies, and most companies will negatively be impacted in one way or the other. Also, as well, the US tariffs are quite complex. So instead of trying to speculate, it's probably prudent for a lot of investors to just focus on what we can control, and that is the management of our portfolio. So focus on being diversified across a range of high quality companies, even though some of those companies might be temporarily impacted. Also focus on financial health. And also any competitive advantages that a company may have in its space, because once these tariff impacts or headwinds dissipate, then they are likely to regain ground and potentially see earnings grow back as well.
Yeah, that's right. And also keep track of company announcements, especially if companies are coming out with any announcements on tariff impacts and the earnings revisions under Golden Rule 3 as well, to stay on top of those active risks. And if you are trend sensitive, remove those stocks from your portfolio if it breaches the SD30 TSR. For other investors, though, share price volatility does present opportunity to gain exposure to these high quality businesses. But that's all we have time for today. And thanks again, Jace, for joining us.
Thanks for having me, Kien. It's always a pleasure. And yeah, for any members that still have any questions, please reach out to us on Lincoln Live every Monday.
Yeah, I'm sure there's plenty of questions, especially around this volatility. But remember, embrace the volatility and block out the noise. Focus on what you can control, and that's the management of stocks in your portfolio. In the meantime, take care and have a happy, healthy, and prosperous week ahead.